So I've got kind of a chart, but it's also a tweet. And I think many of you will have seen this tweet, which was posted a couple of days ago. This tweet shows the most revenue efficient companies in the world. And the metric specifically is revenue per employee. And so, as you can see here, OnlyFans is very, very efficient in terms of revenue per employee. And then we've got at $37.6 million of revenue per employee. We've got companies like NVIDIA, Cursor, Apple, Meta, Alphabet, OpenAI, Microsoft, Tesla, Amazon following suit. And so, I think these are mostly going to be companies that have reported some type of public figure. So maybe there are some private companies that are, even more efficient than that. But I think this is interesting because just how efficient OnlyFans is relative to these more traditional businesses that you see below it. And then, Ryan Watkins replied to this and highlighted that actually some of the most revenue efficient orgs in the world are actually in crypto. And so even compared to OnlyFans at 37.6 million, Hyperliquid's at roughly 85 million per employee and Tether's at roughly 65 million per employee. So I think this is a really interesting thing to talk about because I think there's a couple things going on here. I mean, number one, I think, the first observation here is that all these are tech companies of some sort. That's not super surprising given that tech companies tend to be some of the most high margin companies, period. So I don't think this is too much of a surprise, but I think, one other thing that's probably worth calling out is that the vices tend to sell very well. And so, OnlyFans obviously is a part of that, but you could even argue something like Meta is a part of that, right? Where it's tapping into kind of vanity and people kind of showing off and that kind of activity. You could also argue that Hyperliquid's a part of that, right? It could be seen as a form of gaming or gambling. Some form of trading could be considered that as well. So I want to pause here. I'm really curious to get your guys' reaction to this. I think this is a really interesting phenomenon.
Yeah, it's not just this one, right? If you had Pump.Fun up here at its height, you would also see some crazy numbers, not just because the revenue was very high, but also because the number of employees there was even smaller, right? At some point, there were like 15 people, and they were pulling in over $500 million a year. And so those numbers are also kind of like, they would be higher than OnlyFans here, slightly lower than Hyperliquid. So I think the vices is right. I'm actually surprised that there's only one of the vices here on this list, really, even though you kind of like hinted at Meta as being a social, but it clearly is not an outlier. It seems to be hidden amongst the rest in terms of like normal companies. It's fascinating. We're only going to see more of this, I think, right? The cool story about AI and all of the advantages that we have is that this has to continue increasing. Either the companies that are traditional companies are going to catch up, which would be an interesting conversation to have, whether those 3 points or those, whatever, $1.1 million for Microsoft to choose one is going to increase maybe 50%, maybe double, or if we're just going to see a new breed of companies that's just going to be, the first one-person unicorn, as people keep talking about.
Yeah, a couple thoughts come to my mind. I guess the first one is on the vice question. Do you consider laziness a vice? Because if you do, then I think every tech company kind of fits into that because we're making tech into more to make a product more productive. So like
isn't sloth one of the 7 deadly sins?
So there you go. Amazon helps us so that we can order stuff, don't go into the store. Tesla, we don't have to drive. OpenAI, we don't have to think. So I think it's an interesting observation. I guess the second question that I kind of end up asking myself is how defensible are these? And I guess it's mostly relevant for Hyperliquid and Tether because a lot of the companies listed below are really massive companies that certainly are defensible. And OnlyFans obviously is a network, so we know the power of network effects. Which is why I think it stands out as being so much higher than everything else and being a network effect. It's been able to monetize where most network effect companies haven't been able to monetize as well. And maybe that's kind of why that's the way it's related to Hyperliquid, where because it's directly in the value flow of a user interaction, like where they're paying for the service innately, it's not a social network or something, that they're just able to take a high take rate. But it's interesting also because Hyperliquid and Tether are completely different types of companies, right? Tether is just a stable coin. It's like it's net interest income, right? And Hyperliquid is taking trading fees. So like on balance, these companies probably couldn't look more different. But the fact that they use crypto is the only thing that they share.
Yeah. I think, a couple of years ago, people had talked about how smart contracts were going to bring this wave of efficiency and bring this wave of just automation into the world. And, neither Hyperliquid nor Tether really represent that. But it's interesting that those are the examples that are cited here. I do think that both Hyperliquid and Tether, what it does represent is that actually with crypto, you get a global market on day one. And so while an Amazon or a Tesla or an Apple, for example, had to take years of investment in order to open up global markets, something like a Tether is global on day one. Like it quite literally is, that is the product and the point. OnlyFans is kind of similar. It's global, right? So
I was going to use it for OnlyFans, but I was definitely going to use it for crypto. One of the biggest advantages I keep saying for stablecoins and the opportunities is the fact that it's global from day one. Same for RWAs. One of the advantages of wrapping some traditional asset in an RWA and putting it on chain, it becomes global. So fractionable, liquidity access from all over the globe day one. So that absolutely is the case, especially if you think about the fact that what we're looking at is on a per employee basis. Every other company, think about a traditional fintech that wants to go to 150 countries, has to essentially localize for 150 companies, have local people that understand the market, have local partners, support, compliance, legal, etc. And someone else that is crypto that just totally ignores that and has as a settlement layer, the blockchain layer, really. All of a sudden doesn't need any of that. You don't need people to go localizing, and you're sort of benefiting partly from a regulatory arbitrage, partly from the fact that everybody else is doing it. And so the number of employees is particularly pronounced for crypto because you don't need to go to market for every country that you have.
So what we're saying is that AI companies will be the most efficient. Crypto companies will have the immediate access to a global market. So that means that crypto AI companies should be the most valuable companies in the world.
That's exactly right. This is not investment advice, remember?
Yeah, not investment advice. We're going to see triple-digit millions per employee at some point this decade.
I
love
sure. That. No, I mean, we keep promising $1 billion, the unicorn, one-person unicorn. I haven't seen it, but it's going to be a crypto AI company for sure.
All right. Good chart. Who's up next?
I'm up next. Okay. So I mentioned this last week, actually, but I wanted to bring it in full. What I'm showing you is a chart. The General Data Protection Regulation, also known as GDPR, and entry of successful apps. So what it shows you is on the y-axis, you have the number of new apps that reach 100,000 cumulative downloads relative to the quarter before privacy regulations, which was 2018 Q2, and then after. And on the x-axis, you just have time. And so essentially what you can see is that GDPR took effect and number of apps that reached 100,000 cumulative downloads just took a nosedive. This is extremely interesting. So the history of GDPR in Europe is that it was supposed to protect privacy and it was going to create fair competition. And what happened instead is what we keep talking about AI too on regulation, which is instead it crushed the small businesses and strengthened the tech giants. Google and Facebook absorbed the cost of this super easily. I mean, we were just talking about revenue per employee. They're very much up there in the charts, and European startups just can't afford the regulatory burden. So I wanted to give you like a couple of stats that I think are interesting. So first, there's been an 8% reduction in profits for SMBs. So the disproportionate cost has been felt by the SMBs. The venture ecosystem in the EU actually is down. It's down in the US too. I think relative basis is even further. As you saw here, 47% fewer app launches. And as you also know, empirically, there's been hundreds, if not thousands of startups that moved their operations to the US because of this thing. So part of the issue obviously is the insane complexity. You have special legal teams that are needed for this. There's massive fines on the other side of this. I don't know if you knew this, but you can actually be fined for not complying with GDPR up to 4% of your global revenue. Global revenue, 4% revenue. And it's super restrictive in terms of operations. Obviously, the documentation and everything else requires tons of resources. And funny enough, the cookie that you have to allow all and ignore, like that cookie banner that makes every single website in Europe be much worse and makes me use a VPN. So and I come from the US, so I never have to actually accept that thing. That's even not the worst thing for me. The worst thing for me, and the thing that annoys me the most, is actually GDPR created this industry of compliance consultants and law firms and experts that just are benefiting from the regulatory maze. It's just insane. Another stat that I saw was that there has been almost $8 billion spent by Fortune 500 companies alone on GDPR compliance, over $1.1 billion in the UK alone. And so one of the things that I wanted to bring up is not just this is happening with GDPR, but it's also clearly now happening with MiCA. We've been talking about MiCA, the regulatory regime for crypto in Europe, and it's already being felt. There's a lot of companies that are about to actually not have the provisional license anymore because they're not going to be able to meet the requirements because they don't want to pay or can't meet the regulation. Obviously, Tether is going to be one of the assets that doesn't seem to be looking for the regulatory clarity of MiCA in Europe, and thus will have to be delisted. Obviously, in the case of Tether, it's not because of money, but there's lots and lots of small startups that just won't be able to operate. And I think some friction is expected whenever you bring a new regulatory regime. And I don't think it will be to the scale of GDPR in terms of costs and just disincentives for businesses, but the same thing is about to happen to crypto companies, and I'm already seeing it. And so I wanted to bring this chart and continue the conversation of last week because it's kind of a harrowing stat and a bad outcome.
Man, it really highlights two things, right? It's the cost of regulation. Regulation is obviously typically meant to have good intentions, meant to either protect consumers or, protect other folks or make sure you have standardization such that people don't get frauded, etc. So it has good intentions. But obviously, there are downstream effects. Clearly, with GDPR, MiCA is another one. I mean, like Starbucks is another classic example. There are countless examples of how regulations with really good intentions have ended up having adverse consequences. And I think one of the things that we don't do very well is when a law gets introduced, we don't really do a postmortem on the effects of that law. And we also don't really have the ability to predict everything that's going to happen once you introduce it. And so that's the real actually challenge. It's not that we shouldn't have regulation, it's that once we have regulation, we should actually be able to review the impacts of it. And if there are aspects of it that we don't like, we should, have some type of process to go and revise it. So I think that's the first thing. I don't know if that's really feasible in the current environment of how regulations get introduced, but the ideal version of that would be something along those lines. And the second observation, this is more specific to privacy, is that I think we talked about this last week as well, but privacy it can't come at the cost of convenience. I mean, clearly it can't. We know that intuitively, and we know that just anecdotally through the folks that were around who, even though they say, I don't want people selling my data, they don't bother to go into the settings menu and actually even change that setting. So we know all this. Clearly, privacy, if we're going to have it, is going to need to be just as convenient as the option without it.
Yeah, Diogo, one of the things that I was kind of trying to understand as you were walking through GDPR is, for those costs, isn't that an opportunity for a business, not a consulting service, but a technology business to plug in horizontally? We've kind of seen that happen at the KYC compliance layer, where you can automate some of that headache and it creates regulatory capture for the company that's able to do that the best, and they kind of are the provider for everyone. And does that exist for GDPR? And then maybe we could extrapolate that to what that means for MiCA.
I think there's lots of ways for you to essentially have frameworks and cloud providers and tools that allow you to ease the compliance burden. But at the end of the day, every time you're collecting user data, you have to go through the analysis of whether this data is or is not under the scope and how you store it, and make sure that the end provider, it makes it's unnecessary friction, and it makes everything harder. Everything that touches data is harder. And I think we could make the steel man of the argument, which is data, consumer data and user data should have a lot of friction built in whenever you're, messing with it or touching it or storing it. But the reality is that it's sort of like PCI DSS in the US. The regulation ends up being divorced from real security. And meeting PCI DSS to a large extent does not mean that you're safer. It just means that you check the boxes. And so a lot of that is happening now. And I think that's actually, it's just the reality of some of these regulations. They end up just being check the box and not actually at security, because they end up being divorced from real security benefits.
Yeah, that makes sense. And so for MiCA, what does it mean specifically? It means that to be a new issuer of stablecoins, that it'll just be more friction, and there will be, tens of them versus hundreds of them or thousands of them. Is that the high level idea?
Well, it's actually anything that touches crypto. So it's not just stablecoins, right? It's anything, if you want to trades, if you want to be an exchange, if you want to custody, everything else. It's going to require MiCA licenses. There's some stuff that is out of scope right now, DeFi and NFTs and things like that, but everything else is kind of under the scope. So basically think about all crypto companies virtually that touch crypto assets in the name of the user will have to abide by this. And people are actually thinking about MiCA 2.0, which is an even stricter version of this. Yeah, and MiCA 2.0, in the current conceptualized version of it, is going to potentially reject non-European issuers of stablecoins, period. So you would have to be a European stablecoin issuer to actually be able to be in Europe. My understanding is that even if you are a dollar issuer, you'd have to be regulated in Europe. And so,
interesting.
kind of
that one is staggering. It's not about a euro stablecoin, but it's literally anybody that is issuing a stablecoin needs to have a European entity.
Anybody that wants to list a stablecoin available to a European citizen
in Europe
would have to meet it. To be fair to Europe, GDPR is coming under a lot of scrutiny from Europe itself, and the recognition that in the past 8 years, it's not really achieved the benefits that it was supposed to achieve. And so there's some, let's say, red lines that are about to be applied to GDPR. There are positive red lines, but that hasn't gone forward. It seems like there's movement and momentum towards it, but it still feels like Europe shooting themselves in the foot again.
Yeah, regulation creates hardening, right?
Yeah, fair. I mean, one argument here is that the worse it becomes, it's a pendulum, right? So it's kind of like the reaction of the market, and Europe will react on the other side. So hopefully that happens. Bryce, you're up. Bring us something more upbeat and more positive.
Yeah, we'll bring it home. Okay. So I've got 2 charts. We'll start with one and we'll move to the next. This first chart is a chart that shows the average megagas per second for different Ethereum clients on this new Ethereum performance net. This is tweeted out. It's a little dated now. This is probably almost a month ago from Storm over at Paradigm, who does a lot of data stuff. And what this represents is some performance testing for Ethereum clients. So right now, historically, I guess Ethereum has decided that they're not going to scale the L1. Earlier this year, obviously, that's ruffled a little bit of feathers within the ecosystem, and we actually increased the amount of gas per block in Ethereum up to 18 million gas as the target. And because Ethereum has 12-second blocks, the way that people tend to talk about the throughput of Ethereum is mega gas per second, or millions of gas per second. And there's been a large push with the new co-director of the Ethereum and some of the competitive dynamics with other more performant L1s and even L2s to try and make Ethereum L1 higher throughput. And so to do that, we have to actually do some instrumentation of the existing clients because Ethereum is decentralized and there's multiple clients. You don't want to push the network such that there are clients that fall behind. And so this chart shows some basic performance testing of the existing clients today at the execution layer. And I think what's interesting is that right now Ethereum's at 1.5 megagas per second, but there's clearly a lot of room to go. You can see the lowest on this chart is something in the 50 megagas a second, but they're able to sustain higher load at, closer to 100 megagas per second, which is, 60 to 80 times higher than Ethereum is today. And that has like pretty profound impacts on the way that we should think about the network. So right now, the way to think about, let's talk some numbers about throughput. So the average transaction size in Ethereum today is something like 75,000 gas. The cheapest thing that you can do on Ethereum is just send ETH. It's like 21,000 gas. And to send a ERC20 transaction, like just transferring like USDC or something, is like 60,000 gas. So people are mostly sending tokens. Maybe they're doing some more complicated stuff in DeFi. So the average transaction gas cost is 75K. If we're at 1.5 million gas a second, then we're doing 20 transactions per second. If we go to 100 million gas a second, then we're at something like 1,300 transactions per second, which looks closer to what's happening on Solana land. And so I think just the fact that we're even testing this stuff in a development environment is shifting the Overton window for Ethereum quite a bit and will have some profound impacts. And I think it's basically an acknowledgement from the leader in smart contract platforms that we're actually undergoing the innovator's dilemma in real time. Like we can't just sit and be lazy and try to do things off the L1. We're not going to be like Bitcoin. Like there's no such thing as like luxury compute, right? Like you can't move from digital cash to digital gold like you could with Bitcoin. We actually have to be competitive, and we need to basically, follow the cost of compute as it comes down over time. So I'll pause here. Would love to get your all's thoughts about this, and then I'll move over to the second chart next.
Do you know what the patterns are? Actually, just curious.
No, I don't know why it looks like steppy. I don't know
step
exactly
functions.
know. Yeah.
Okay.
I mean, this is a really cool chart.
I have to imagine it's related to the complexity of the transactions, like the way that they're packed.
Yeah, you're right.
Or
The
maybe
fact the transaction or the time scale is actually pretty short, right? This is a few minutes apart, right?
That's right.
It's 5 minutes.
That's right.
Yeah. I mean, one observation I think that's a cool one is that the client teams are actually pushing the frontier forward, regardless of what the stated standard or the requirement is from a protocol level. And I think that's a really cool and interesting phenomenon that's happening in Ethereum. I don't know. I mean, maybe you could claim that with Firedancer and Solana as well. But that's a pretty unique feature, I think, for Ethereum that is here today. And I think, we should expect that motivated teams that are small and actually, putting these in production are going to be the ones that are going to lead us forward on these things. And then, obviously we have to do a good job to, revise the standards or raise the lowest common denominator for the protocol to start to meet the realities of what's needed out in the market. So I think number one, it's really cool that the client teams are pushing this forward, regardless of what the stated lowest common denominator needs to be from the protocol. I think the second thing that I've been thinking about is, in the same way that I think Bitcoin had to go through a cultural moment and they needed to define what their culture was, I think Ethereum is going through a somewhat similar trajectory. So, if we rewind a couple of years ago, there was the ultrasound money meme for Ethereum. And I think the conversation around Ethereum was more around how do we create a monetary premium for ETH the asset. And I think today we're talking about something very, very different, which is, okay, if we can't have luxury compute, then how do we make sure that the compute is competitive? Which is a lot more, it's, one's a monetary discussion and the other one is a performance discussion. And those are very, very different in terms of if you want it to be a monetary premium asset, uh, there are certain things that you would do that will make it different than making compute as cheap and fast as possible. And so I think Ethereum is going through this real time. Breck, I think, you mentioned it as the innovator's dilemma. I think there's a part of that. I think there's a part of it, which is Ethereum's trying to figure out what type of culture it wants to be. And I think we've gone through a couple of iterations of that. So, overall, I think it's really good that Ethereum as a community is asking itself the questions, because I think the worst outcome would be you're trying to do all of these things and you're actually none of them. And that would be the worst of all outcomes, I think.
What is the, let's assume that we move forward. So at the lowest end over here, 100x. So instead of 20, we now have 2,000 transactions a second or something. So let's assume now we're at 2,000 transactions a second. What do you think? How do you guys think this goes forward? Is it that we continue to retain the liquidity effects and people continue developing on Ethereum? It's still the largest in terms of many of these metrics, TVL, et cetera. And we just continue to retain and people come back or don't move away and build? Is, the L2 game just too far gone and people just continue to migrate away because incentives are one of the things that you can do when you issue your own token, and incentives run crypto. And so people keep migrating because let's see who pays the most. How do you guys think this goes forward?
So this is a great question, and I'll just use it within the frame of the second chart. So this is from Grow the Pie, and it shows you the amount of megagas per second that's on Ethereum today, which is roughly 80 megagas. So like basically if you went to the bottom of that chart, you would effectively double the total throughput of Ethereum plus its L2s. So you would, one question you could ask is like, are you Sherlocking all of the L2s? Which is, I think, in spirit of the question you're asking, Diogo. My answer to your question is throughput is only one of the levers to pull. The other is latency. And right now, L2s have an advantage to the L1, which is that they're both higher throughput and lower latency. So for things that look like trading experiences, for things that are consumer experiences, it's just like snappier, better products. And that won't change just because Ethereum has higher throughput. Ethereum will still have 12-second blocks in the short term. I think there's some initiatives to try and compress that down to, maybe 6 seconds, 4 seconds, but I don't think they'll get to a place where they're sub-second, and that's definitely where L2s are going. So I definitely expect there to still be advantages at the L2 layer on that front. But I think you're right in that what I would expect to happen in the short term is that composability or programmability at the L1 layer for the large amounts of TVL will just get better, and we should expect there to be more innovation on L1. I think we'll also probably see some people try and launch natively on L1 because of that TVL sort of advantage. But I do still expect new asset issuance and some of the like trading type of experiences to be off of L1. But it's hard to say. It's hard to say. I think
outcome.
Right now people are definitely just not launching L1. Period. Like if it'd be interesting to look at like new smart contract deployments on L1 versus L2s. And I have to imagine that new L2s dwarfs L1, and maybe the relative percentage starts to shift back in the favor of L1 with higher throughput.
Yeah. So for some certain subsets of use cases that require super low latency, tradey type of things, it's likely that people will either go to their own L1 or they'll go to the L2s. But for a much larger scope of apps, which is basically right now no apps want to build on this L1, but for a much larger set of apps, this actually might be the right thing and simpler. There's already a lot of like tools and ecosystem, et cetera, and they benefit from liquidity effects and from the smart contracts that are deployed. So that could be the most probable outcome. It would also be interesting to kind of like overlay this on cross-chain in blockchain abstractions and intent as a side-by-side, because that's the other thing that is kind of like ongoing simultaneously that could alleviate all of this. Is like, who cares if it really becomes somewhat indifferent, because not for the low latency solutions in which we have an issue there, but for the general application, why would you choose on a specific layer one if you could kind of like get the benefit of selecting them all? That could also be something of a dark horse that emerges that Ethereum, can't control and can't do much about.
Yeah, and the metric to watch probably is like native asset issuance and flows between the L2s and Ethereum. Like, are we seeing new assets issued on ETH, or are we seeing non-native ETH assets actually move off the bridges and circulate amongst L1? Obviously, I think we have quite a ways to go before performance net actually turns into mainnet, but we're just starting to like see these signals happen. Sweet.
Awesome.
I think that's a wrap for this week.
And next week, I will come up with something a little bit cheerier and rosier. I promise.
Yeah, this is a downer episode in some ways. Talk about sad topics.
No, we just had the shit sandwich, right?
That's right. Shit sandwich. Nobody will remember it. It starts good, terrible in the middle, and then it ends well. Awesome, guys. See you in a bit.
All right, see you guys.
Bye.